In this video, we are going to have a look at accounts receivable and accounts payment in terms of the working capital management. So accounts receivable then. The first thing we need to have a look at is the ability to actually establish a credit policy. So there's a balancing act involved here then. So if a business is going to offer any credit to its customers, it is very important that the optimum level of trade credit is going to be reached. This means that there are two factors where a balance needs to be made. So the first is that profit improvement from sales needs to happen. This should only be achievable by actually allowing customers to pay on credit. And the second of all is that the cost of credit is going to be allowed. Why is a credit policy important then? Well, it's part of a marketing strategy. It has a wider customer base, and it's also going to be quite lenient at times. If that is the case, it is going to attract more customers, but an entity will see an increased cost. So there are many different influences then upon when offering customers credit. So what can impact this? Well, a business may have a look at their credit control costs. They may focus on product demand. They might have a look at the risk of irrecoverable debt. Some businesses are going to be able to take on more debt than others. They're going to have a look at competitive terms and how much will this actually cost the business to finance in the short term as well as in the long term. So, aspects to receivables management then. So first of all, customers' creditworthiness should always be assessed. Once you have assessed the creditworthiness of your customers, a business is then able to set credit limits. They should, however, invoice their customers promptly, as well as chasing and collecting any overdue debts. In order to do that, they must ensure that they have some sort of system in place which allows their credit to be monitored. How can creditworthiness be assessed then? Well, bank references, competitors. They could use credit reference agencies, or they may even use a trade reference. An entity's own sale records. So if you have proof that a customer has been coming in and paying you in cash for multiple months or multiple occasions, you are going to be quite comfortable that that customer does have the satisfactory funds to be able to pay, and they may just be wanting to pay on credit in order to improve their own cash flows. It could also be down to individual credit scores. Legal sources of credit information, so does a customer have a county court judgment? And it could also be through visits to the customer's premises. There is also going to be published information which an entity is going to be able to access. Think to Companies House, think about the annual accounts that are published on there for every entity. So what should an entity take into account then when setting these credit limits? Well, how much credit is going to be available? How much time are they going to allow before that payment is due? Now, for some entities, they may decide to have different credit terms for different customers. Invoicing and collecting overdue debts then. So how to chase, essentially. So the first step for any entity chasing a debt would be to send a reminder letter. That can either be by post or via email. In today's world, email is probably the most efficient and will also most likely get there safely. The post can get lost, it can get scrumpled, it can be sent to the wrong address. By sending it via email, you are not giving the client an excuse as to why they have not received it. If a business has no joy by sending the letter or the email, they should then jump to actually calling that client to chase that payment. If neither of the above work, they could stop supplying to their customer. And as a last resort, they could go to a debt collection agency, and if they still can't collect it on the entity's behalf, the final step, if a business wanted to take it, would be to take legal action. But do bear in mind that if a business chooses to go down this route, there is likely going to be high costs incurred. So, how can we motivate credit control staff using collection targets then? Well, targets can be set for multiple ways and factors. So, individual members of the collection team, or they could be set for the credit control team as a whole. Each business model is likely to adopt a different approach. How do we monitor this system then? Well, we can run an age analysis of any outstanding debts. We could use our ratios, and we could use statistical data. Some businesses will choose to use one of the three, whilst others may use a combination of all of them. So how can receivables be financed then if we are not getting upfront payment? So receivable balance multiplied by our interest rate. And this can be calculated through our receivable balance being equal to our sales multiplied by our receivable days divided by the 365 days in a year. Early settlement discounts is also something else that can be explored. And in order to calculate this, we would do our annual cost of discount as being 1 plus our discount over the amount left to pay minus 1, multiplied by the number of periods. So the number of periods then depends on whether you are calculating on a weekly, monthly, or annual basis. So it could be that you are doing 365 days or perhaps 52 weeks, etc. You would then divide that by however many months, weeks, days the money is received as of early. So do note then the cost calculation is always going to be based on the amount that the entity has left to pay. So with accounts receivable then we can have a look at something called factoring. But what does this mean? Well, factoring is essentially whereby an entity will sell its debts onto a third party at a discount in return for prompt cash. It is essentially a form of debt collection and can act as credit insurance. It is common amongst many smaller firms and fast-growing firms who perhaps have a smaller amount of cash in the bank and need to get this cash paid to them promptly in order to improve their cash flow position. Obviously, with factoring, there comes many advantages and many disadvantages. So some of the advantages of this is the management control is going to be reduced as well as admin costs. It is going to be good for any businesses where credit control departments are either small or non-existent. And it may be able to complete creditworthiness checks on the entity's behalf, which is obviously a cost saver as well as a time saver. On the flip side of this, we do have some disadvantages. So if a business decides to move to a factoring system, but then wants to come back to bring credit control in-house, they may find it very difficult to form an internal control account system. It can obviously be costly because you are losing a part of that invoice. And it can lead to the business actually gaining a poor reputation, leading to a damaged goodwill. Your customers may eventually go elsewhere. Obviously, your customers have come to you, they trust you, they want to deal with you. If you put them in the hands of a factor, they may not be too happy. Invoice discounting then. So this is a method of raising finance against the security of receivables without having to use the sales ledger admin or factor services. So selected invoices are going to be used as security against which the entity may borrow funds from. It is going to be a temporary source of finance and it will be repayable once the debt has been cleared. Unlike factoring, invoice discounting is a confidential service and the customer doesn't need to know anything about it. They will not find anything out unless you, as the business, let the customer know. Moving on then to accounts payable and managing trade credit. Again, we have a balancing act. So it's the trade-off between profitability and liquidity. So with this, if we delay too long, it may cause difficulties for the company in the long term, causing profitability issues. If we delay payments to suppliers to obtain a free source of finance, we may run into a liquidity problem. So issues arising from delaying payments to suppliers then. So suppliers may refuse to pay in the future, and suppliers might only supply on a cash basis. We could always lose our reputation as well through doing this. Because the suppliers are beginning to get a little bit knocked off with us, we could also see an increase in prices from them. So in order to sort of work around this problem, we can get an aged analysis of our payables. So how much is payable to our suppliers and when will the money be payable? What are the amounts payable to each individual supplier and how close is our credit limit to pay the supplier? And is the entity paying their trade suppliers on time? All of these factors need to be taken into account if we are going to benefit from our trade payable credit terms.